All right, next we are going to take a look at the limited pay whole life insurance product. So a limited pay, as we touched on briefly in our overview video, is typically referred to, the most common option we'll see is a 10-pay product. You'll often see 20 pay, sometimes 15 pay, 12 pay. There's a lot of different products, and frankly, it depends on the insurance company and what they offer. But a limited pay product means that I can make premium payments for a limited number of years. Unlike a traditional whole life insurance product where I can pay into it up until I'm 100 years old or 121 if I wanted to, not that many people do that, but unlike a traditional product, a limited pay product will not allow me to do that. For example, a 10-pay policy is paid up in 10 years. Even if I wanted to add more premium after the 10th year, I often cannot. Now, some people are very attracted to that. Maybe I'm 45 years old and I say, hey, at 55, I want to stop. Maybe I'm 50 and say at 60, I don't want to have to be adding money. I've got a lump sum of money. I'm going to move it over in 10 years, over a period of 10 years, and be done with it. Again, a good option to be aware of. So let's take a look here. When I'm paying money into a product, here's what I want to be aware of. If I'm paying $1,000 per year into the premium piece, what happened with the traditional whole life? First and second year, nothing shows up in cash or a very, very small amount. With premium dollars on a limited pay product, let's focus on a 10-pay here because they are all a little bit different. You will see approximately 33%. And why I say 33, it's going to depend on the insurance company primarily. It's often between 30 and 35% of my base premium payment show up in cash value. So if I had a $1,000 base premium payment, I might see in year one, 33 show up. So call it $330. Year two, I pay $1,000 in, you'll see just about all of that $1,000 show up in cash value. So they are primarily overcharging you in the first year and not for the full amount either. So I make a payment, I see a portion of my payment, my base premium show up in cash value right off the bat, and it begins capitalizing much earlier. It's going to be really interesting to see what the all base premium policy does in terms of a break-even point. So year one, 33%. Year two, let's call it 100%. Approximately, again, depends on the company, the product, age and health will play a role there too. Now, I've got 33% right off the bat. Why it's not 100? Very similar to the traditional whole life product, the company is going to overcharge me for the death benefit. Now, if the whole life product, if a $1,000 premium purchased me $50,000 in death benefit, with a 10-pay, it may only purchase me $20,000. The reason why is when I look at it from an insurance pricing standpoint, base premium dollars from a 10-pay, for instance, I can only pay into it for 10 years. So that same $1,000 will not buy me as much life insurance as a traditional policy would, because that's payable up until age 100, meaning the insurance company is counting on receiving premiums for a long period of time, whereas with a 10-pay, it is not. Now, if you're listening to this and say, okay, I don't care about the death benefit, Steve, I'm interested in learning about the cash, well, where this will have a play, or where it will have importance, MEC laws, which we'll touch on that in a second here. PUAs pay the same $1,000 in. This works just like a traditional policy and everything else. Shows up in cash value, money I can access, and buys me some death benefit as well. All right, let's take a look here. Limited pay products. So we wanted to provide a little bit more information here, because we always like to do that. So we ran a 10-pay and 20-pay option. So a 10-pay whole life product, premiums are payable for 10 years, 20-pay, 20 years. We ran this option with a 45-year-old male. Let's take a look. On the left, all base premium, $50,000 per year for 10 years. There you go, right off the bat. I pay in $50,000. What's my cash value? $17,000 and change, right around 33%. If you have a calculator, it'll come very close to that. Year 2, I pay in another 50. I go from 17 to 61. Next year, 61 to 108. So I see most of my premium coming back. I'm beginning to compound as well. Here's where a 10-pay product is nice in my opinion. 100% base premium, no blending at all went into this example, crossing over by year 8, break-even point. The guaranteed values, the guaranteed break-evens are decent on those products as well, again with 100% base premium blends. So it's a nice option to be aware of. The key drawback here is typically by year 10, people are really starting to like a product and its performance. To stop funding after 10 years, not everyone's into that. Some people are, and that's where your personal situation comes into play. So all base premium example, there we go. Then you've got the blended option, max blend with term rider, breaking even between years 4 and 5. Year 4, man, I'm almost there. I've paid in a total of $200,000. I've got $198. After the 10th year, $582 in cash value. All base premium option, $552. Right, just about a $30,000 difference. Now, as time passes, right, the max blended policy, and this is almost always going to be the case, will continue to pull further and further ahead because by blending the policy, we blended it in a fashion where we reduced the premium, optimized the PUA to enhance the cash value performance, short-term and long-term. Let's look at the 20-pay example here. Actually, let me back up. Back to the 10-pay with the all base premium example. Death benefits what? $50,000, 1.2. Let's go back to the traditional. 4.3 million. Now it's a 35-year-old male instead of 45, but still the $50,000 policy purchases one way more death benefit with a traditional policy, a basic whole life product, compared to the 10-pay product because premiums are due for a shorter period of time. Let's progress on to the 20-pay. Oh, one more thing I keep forgetting. The MEC limit on this example is just over 50K. So unless you add a term rider, which we did in this example, it is very, very difficult to add PUAs to a 10-pay product unless you have a term rider. 20-pay. Very similar, only I can pay into it for 20 years instead of 10. Year 1, they overcharge me for the death benefit. Year 2, I pay in 50. Most of that 50K comes back to work for me, and then more and more each year. So really, they are overcharging me for the first year. Now what's interesting about this, very much like a traditional whole life policy, which took 13 years to break even with a all base premium example, same thing here. I've paid in $650, I have $659, so a little bit more, but it took some time. Compared to the blended example, year 6, I'm positive. I've paid in $600 and I have $600. Same thing though with the cash value difference. The blended policy on both examples, I see more from start to finish. And that's something I always like to look at. I mean, you may have seen different split studies where here we've got an all base premium example compared to a max blended policy. There's times we throw a 50-50 in there, a 30-70, a 40-60, because really the name of the game is how do we optimize the cash value? That's our focus as a company. And then we look to do all of the other strategies afterwards once I've got an optimum policy or optimized policy. So overall, with the limited pay whole life products, the advantage is that I only have to pay into the product for a limited period of time, 10 years, for example. The disadvantage is that I can only pay in for 10 years. If there's any chance when you are considering a whole life insurance product, there's any chance that you might want to pay into it for a longer period of time than 10 years, for example, then a 10-pay might not be the best option. It's good to consider. However, when you hit year 10, or I should say year 11, if you decide I want to keep paying money into a whole life insurance product, do I want to pay money into an existing policy, if I have the means to, that's already over the insurance expenses, or do I want to start all over with a new one? Yeah. If I start all over with a new one, I've got to go through the initial costs again, the initial insurance expenses, the startup phase, call it. It's not that pleasant, as opposed to paying money into a policy that's already compounding, that's going to enhance my death benefit as well, gets better and better. So like any option, it's great to be aware of. However, depending on my situation, it may or may not be a fit. As always, I hope this helps. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.